discuss more on what the government can do in the short term. We're now joined by Siddhartha Sanyal, Director and Chief Economist of Barclays Capital, and Keki Mistry of HDFC. Gentlemen, appreciate you joining us. Siddhartha, let me come to you first. Everybody expected an ugly number. The consensus on the street was 6.4%. It's come in higher at 6.7%. The worrying thing is that the government is clear in the short term there don't seem to be any quick fix solutions or policy prescriptions that they can actually use to control the CAD. What do you anticipate to be the forward action? Because things like NRA bonds are not on the table, is what we're given to understand from our sources. How does the government tackle this in the short term?
Yes, you're very, very correct. In the sense, there is no quick fix on the current account deficit side. So you have to ensure that the capital flows remain strong. We remain supportive of the view that NRI bond should be used. But I agree with you, it doesn't look like that the government is really in favor of that. One measure which we think still possible in the near term is some kind of favorable tinkering in the withholding tax, which can actually offer some kind of further impetus to the FII investment story so far as debt instruments are concerned. One area which the government has repeatedly tried to address is that of gold imports. Now, the important issue here, at the moment we are importing something close to $60 billion a year. Till a couple of years back, we were importing somewhere close to just around $30-odd billion. So, if we can be more harsh in terms of our regulations if required, this number, even if a $10 billion kind of swing, can change the current account deficit quite meaningfully.
You're saying harsher regulation as far as gold imports are concerned. Our source is saying that perhaps we're not going to see the government move on that just yet, Siddhartha. But Keki Mistry joins us as well. Mr. Mistry, appreciate you joining us on CNBC TV 18. 6.7, much higher than what the street was anticipating. You know, we've been obsessing with the twin deficits, but the current account deficit now seems to be a runaway problem with little options that the government has to exercise to control it.
It has for a long time been one of our biggest problems, and the expectation, the actual number is of course higher than what one expected, but 30 billion was generally the number being talked about, and I think it's coming at around 32.6 billion, so it's about 8% higher. But that is also because of the fact that the trade deficit has turned out to be higher than what was originally expected. The 58 billion, I believe, was the earlier number, and the revised number is close to 59.6 billion. So that is it. But the fact of the matter is that there is a structural issue. Our exports are always going to be a little, problematic in the sense that if you look at the IT sector is so dependent on the state of the economy in the Western world, and with discretionary spending in the West slowing down, it is to some extent slowing down growth of the IT sector. If you look at manufacturing sector, if you look at the manufacturing companies, we compete with several countries in the regions where interest rates are significantly lower. So with higher interest rates over here, our manufacturing cost is higher, and to that extent, our manufacturing industry is not as competitive as our counterparts. Mr. You just talked about our interest rates and how our interest rates are much higher than our emerging market peers. How do you see the Reserve Bank reacting to this number? They have in their commentary previously during the credit policy said that they expect the CAD to stabilize at higher levels, but do you see this impacting the Reserve Bank's decision to move further on rates? It will have some impact on RBI's decision on moving rates. But I stick to what I said earlier. I remember in January we had talked, and you had asked me on interest rates up just before the credit policy, and I said that my expectation was about 100 basis points reduction in rates during the year, 0.25% in January, 0.25% in March, then a little bit of a halt, wait to see what the monsoons are, and then another 50 basis points in the second half of the year. So to my mind, that's still on. Siddhartha, let me come to you. In terms of reactions coming in from the government, they're saying this was expected, that the CAD is peaking at this level and the number in Q4 will be smaller. They're also betting on exports picking up and the current uptick sustaining. Do you buy this confidence, or is this really a case of hope floats?
Well, I tend to concur with the government's view that this particular number is clearly the peak. And incrementally and going forward the numbers should be somewhat softer, but the reasons can be somewhat different. It's not really because exports will be moving up quite significantly. There can be some improvement, but not that will not really be a game changer. What is possible is, again, coming back to the issue of gold. Gold imports in case of India typically follows the trend in international gold price. Now there has been some tapering off in gold prices, both in dollar terms and rupee terms, and if that remains the trend, you can expect some bit of relief on that particular count. And the other issue here going ahead is what happens to the oil prices. Given that particular segment of demand is pretty inelastic, some kind of relief can come if oil prices in the subsequent quarters are somewhat softer.
Well, that's going to be the big hope, Siddhartha, as you pointed out, that gold prices continue to fall and oil prices as well. But given the CAD number, how do you expect the rupee market reacting? Do you believe that the markets have also factored this in? And as I was asking Mr. Mistry, what does this mean for further rate cuts from the Reserve Bank?
Well, I would expect the impact on those two variables should be relatively limited. First of all, it's really looking through the rear view mirror. This number we are talking about the April to December quarter. Now, going ahead, the prospect of the numbers are somewhat better. Number one, so the immediate impact on rupee market should be more in terms of today's rupee inflow or dollar inflow outflow rather than what had happened a quarter back. RBI will possibly be even more cautious looking at this particular number, but this is not that they didn't anticipate, number one. And number two, at this stage, what will a rate cut do to current account deficit as such? It can actually increase the demand for import if there are more rate cuts, and that way it can be detrimental to current account deficit further. But if you see the current situation in the economy, the demand overeating, a possible demand overeating is not really your concern. So that way, given that there has been much bigger risk to growth, I think they would have to still go ahead with some kind of, rate cuts even in the near term. We do actually factor in around 50 basis points further by mid-2013.
Okay, so you expect the Reserve Bank to go ahead and cut rates irrespective of the CAD, but Mr. Mistry, my final question to you, so that doesn't anticipate a big reaction, negative reaction in the rupee markets. Do you also believe that the street has factored this in and we're not really going to see the rupee significantly reacting to this?
I don't see the markets reacting violently to this number, but yes, I do see the markets reacting to some extent. You know, we are so dependent on foreign money coming in because, as I said, our exports are never going to be very competitive, and our imports are always going to be high as long as oil prices remain high globally. So our best hope is that oil prices come down globally because of shale gas or because of whatever reason, and that will help the trade deficit and the current account deficit. But till that time, the rupee will be under some pressure. But if we can continue with the series of reforms, if we can continue inviting foreign money, if global liquidity continues to remain strong, and if FI flows continue to remain as good as they have been, like for example, if you look at the Jan to March quarter, FI flows have really been on the higher side, close to $13 or $14 billion. So all that taken into account, I don't see the rupee collapsing, but a temporary drop in the rupee by 20-25 paisa on Monday morning can't be ruled out.
All right, Keki, Mr. Siddhartha Sanyal, we'll have to leave it there. Appreciate you joining us here with your thoughts on the current account deficit and what it means for the economy.